Can impact investing help save the planet? Activist investors have been making headlines for the past few years. But what is this newish trend and how can it help save the planet? Carried out by hedge funds, private equity firms and endowments, impact investing has become a popular tool for larger companies that want to do their part to combat climate change or other environmental issues. By investing capital in businesses rather than solely owning shares of them, impact investing helps organizations generate revenue while also having a positive effect on society. It allows companies to invest in enterprises that create a social or environmental return on investment. In other words, an organization can make money while also doing good things at the same time. Impact strategies are cropping up more frequently because they offer clear benefits as well as scalability and cost savings. And now that more investors are focusing more on ESG criteria, there's even greater incentive to implement these measures within their portfolios, no matter how small they may be. What is impact investing? Impact investing is a form of private equity in which investors put money into organizations with a mission to create social or environmental return on investment. These are the three main types of impact strategies: companies that use their profits to invest in public goods, like renewable energy companies or nonprofits; companies that generate social and environmental benefits while they operate, like software programmers who give back to nonprofits through volunteer work, or healthcare providers who donate unused supplies to local shelters; investments that provide positive externalities to society, like microfinance loans for small business owners. How does impact investing work? Impact investing works by investing in a company that is pursuing an impact strategy. This can include anything from low-carbon initiatives to community development and benefits to society. The investor then gets the opportunity to share in the business's profits while also doing good for the world. With impact investing, companies get the chance to pitch their investments to investors and offer them a competitive edge over other businesses. With more investors focusing on ESG criteria, there's more interest from institutional investors like endowments who have money to invest. Impact investment will only continue to grow as it provides a win-win scenario for both investors and organizations alike. Advantages of impact investing. Impact investing helps companies generate revenue while also having a positive effect on society. Impact strategies are cropping up more frequently because they offer clear benefits as well as scalability and cost savings. And now that more investors are focusing more on ESG criteria, there's even greater incentive to implement these measures within their portfolios, no matter how small they may be. It allows companies to invest in enterprises that create a social or environmental return on investment. In other words, it offers clear benefits as well as scalability and cost savings. Large institutions such as hedge funds and private equity firms have the financial ability to make these investments, which means they're likely already considering impact strategies. It's effective because it provides an opportunity for investors to diversify their portfolios with a risk management tool that can help them reduce risk without sacrificing returns. Disadvantages of impact investing. As with any investment, there are risks to consider, and impact investing can be more complicated than other investments. Companies who invest in impact businesses typically want to make sure that the business will continue to follow through on its environmental goals after it gets funded. This means that companies should have a solid track record of meeting the needs of their customers and society at large. There's also the question of how much money these companies are actually spending on these businesses. For example, if an organization invests in a company that is making a profit but doesn't contribute to society or help save the planet, then it might not be worth it for them to invest in that company. How to do impact investing with ETFs. Impact investing can be done through a variety of ways. One way is by investing in an exchange-traded fund (ETF). ETFs offer investors access to financial markets, as well as the opportunity to invest in various risk levels and market sectors. They provide a low-cost and efficient way for you to start an impact strategy. This could mean investing in an ETF that focuses on climate change or one that invests in renewable energy technology. How to do impact investing with securities. The easiest way to put impact investing into practice is to invest in securities. Whether you are looking for an initial investment or want to get started on a more comprehensive strategy, impact investing with stocks offers an easy entry point into the world of ESG investing. There are many different ways that companies can be classified, but some of the most common include sustainability, social responsibility, and environmental impact. The first step to choosing the right company is to determine your personal goals. Are you going after a business whose operations have a positive social or environmental impact? Do you want to invest in companies that have sustainable practices? Or do you want to invest in companies that make environmental improvements? Once you know what your goals are, it will be easier for you to find suitable investments. For example, if you wanted to invest in a company whose operations have a positive social and environmental impact, consider investing in a company like Ben & Jerry's. They use natural ingredients and donates 10% of their profits directly back into climate change initiatives. Wrapping up, is investment in environmental sustainability worth it? The benefits of impact investing are clear, but the risk is also substantial. When done right, impact investment can serve as a win-win for both companies and society, but it's crucial to do it right. But what should investors do? In order to get the most out of impact investments, they should think about ESG, environmental social governance, criteria when deciding on where to invest capital. This will help them analyze companies' environmental and social impacts as well as evaluate the risks associated with such an investment. If you are an investor looking for ways to fund your philanthropic goals in the form of profit, impact investing is definitely worth exploring.